Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, April 4th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to view the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So we'll start with today's key macro event, which is our China front-loading stimulus and green shoots globally themes continue to support risk assets, including commodities. So the nuance there is the March composite PMI data from around the world overwhelmingly supported our green shoots globally theme. The March ISM Services PMI report overwhelmingly supported the immaculate disinflation theme at the minor expense of our resilient U.S. economy theme. The latest initial and continuing jobless claims data confirmed our prior assessment that there is a low probability of developing recession in the U.S. economy. That view continues to be confirmed by the 42 macro Fab 5 recession signaling indicators as well. In terms of market implications, Brent crude oil and copper have rallied to 5-month and 14-month highs, respectively. Our China front-loading stimulus and green shoots globally themes call for more reflation in the commodity complex over the medium term. Per the 42 Macro Global Liquidity Monitor, every major economy in the world has a composite PMI reading that is trending higher, and economic surprises are decidedly positive in each of the four largest economies, just as we called for them to be late last year. Refer to our November 22nd, November 29th, and December 5th leadoff morning notes for more details. We are confident reiterating our green shoots globally theme here, which itself implies the risk on market regime, which is currently reflation, is likely to persist over the medium term. I refer to our December 15th and January 24th leadoff morning notes, as well as the right tail risk sections of our last few macro scouting reports for more details. So transitioning to our 42 macro dashboard here. As always, we'll wrap up with a question from our community. This one's about tomorrow's jobs report, after which we'll have our monthly macro scouting report presentation published as well. So we typically publish that after every Friday jobs report, or after every month after the jobs report is released. So be on the lookout for that. Going to be really excited to present that content to 42 macro clients. So getting to the question, I'll just read it here. Says, hello, Darius. Since the prevailing expectations are now that we will see 3 rate cuts this year, and since the market regime is reflation, how will the employment report, exactly NFP and unemployment, impact market expectations, and what are markets waiting for? So it's kind of a long question, so I'll break it down in bite-sized components here. So just answering that first question, how will the employment report impact the market expectations? I have no freaking idea. I mean, I've been doing this for 15 years, and I've not seen any person, and trust me, I've tried to build models for this, that can build a model to accurately predict the jobs report, particularly the most important aspects and elements of the jobs report, vis-a-vis monthly payrolls, the unemployment rate, the labor force participation rate, average hourly earnings. These things are not predictable, certainly not with a standard error that is tight enough to make investment decisions and trading decisions on. And again, this is why very few people I've interacted with across the global buy side try to do this. What you should be trying to do, what we will be doing in the jobs report, is unpacking the entire report, extracting the data sets that are leading indicators for the future state of the labor market and the U.S. economy, and reporting on those for our clients here. So in terms of what are markets waiting for, markets are always waiting for new data. That's not something that's jobs report specific. This is a game where we're always operating with varying degrees of uncertainty with respect to what's going to happen in the economy and asset markets on a go-forward basis. We never have a crystal ball. We never have clarity. We're always operating in an uncertain environment. Sometimes we feel more confident about the near, medium to long-term outlook. Sometimes we feel unconfident about the near-term to medium-term outlook. And this is why we've done a great job for our clients in helping them stay on the right side of market risk by helping them orient their factor long-short preferences and helping them orient their risk management decision making in accordance with the market regime. And our entire research process, as we detail here on this slide here, our entire research process is centered around helping clients position for the market regime. That's step one. And then we help them prepare for regime change using quantitative signals, primarily through our macro weather model, which has visibility on a rolling 3-month forward time horizon. And then we also help them prepare for regime change using our qualitative signals, which is primarily driven by our fundamental research process in terms of connecting the dots for you guys on growth, inflation, and policy. And that has visibility from a risk management standpoint on a 3 to 12-month time horizon, and then from a longer-term thematic standpoint on a 3 to 10-year time horizon, specifically our forthcoming deep dive empirical study there. So again, this is what we do every day at 42 Macro. Figure out what the market regime is, help clients prepare for regime change using quantitative signals, help clients prepare for regime change using qualitative signals. And as we discussed in our recent research, we continue to believe that we're going to exit the risk on market regime, i.e., have a roll phase transition into a risk off market regime at some point in Q3. We'll obviously be a lot more specific on that as we get closer to the timing. And obviously, the only people who are going to get that call in real time are our paying clients. So again, when we think about the risk management process here at 42 Macro, it's about identifying the market regime, positioning for the market regime in real time when it changes, if we have confidence that any sort of change is likely to be a trending change, and we ultimately do. And we've done a great job of keeping clients on the right side of the risk on market regime since it changed into Goldilocks back in November, and it's obviously currently reflation. So when you're in any market regime, you have a set of factor long short preferences that help you stay on the right side of market risk. And this is carefully back-tested data over decades of market and economic performance. Generally speaking, when you're in a risk-on market regime, you're going to want to be overweight risk assets, underweight defensive assets. You're going to be long, high beta, short, low beta, and then so on and so forth when you go down in terms of the different factors in market, cyclicality, style, market cap, regional, geographic, fixed income, credit, commodities, currencies. Again, we blurred off the rest because, again, we don't want to give away the Rubik's Cube to our entire process here for free in this macro minute. But we definitely wanted to highlight exactly what it is that we're doing behind our paywall so that we can help clients, even our own clients, address questions like this. Because at the end of the day, specifically for our retail and RIA clients, I don't think any of you guys have any business trying to make trading calls on jobs reports. The best hedge funds in the world, the macro hedge funds in the world that are clients of ours, don't even attempt to do this. So if you think you're going to retire sooner and come more comfortably because you're making trading calls on the jobs report, I got news for you. You're wasting your time and you're probably blowing a lot of money doing that. So getting back to the question, it's just going to continue to read the question here. It says, could this is not a properly worded sentence, so don't blame me for this. Could release numbers higher than expected change expectations for the number of cuts, causing some bearish conditions in the market? Of course, that's it. But of course, as we've been saying for almost a year now, the number of rate cuts is a parlor game. It's what Bloomberg and CNBC and Fox Business, and obviously I'm going to Fox Business next week. This is what they sell to get you to tune in. But the reality is there's so much more going on economically beyond what the Fed is doing from a policy rate cutting perspective here in 2024. There's 2025, there's 2026, there's green shoots globally, there's China front loading stimulus, there's immaculate disinflation. There's all these things with respect to the entire edifice of growth, inflation, and policy, both domestically and globally, that are driving asset markets. So trying to figure out if it's 3 rate cuts or 2 rate cuts, if that's your entire investment process, God help you, you're going to really struggle to generate positive absolute returns in asset markets on a consistent basis. Getting back to the question, could the release of the NFP numbers lower than expected or unemployment numbers higher than expected lead to markets reacting positively as they price in approaching interest rate cuts? So again, yes, but it's not about get your mind away from, is it 3 cuts or 2 cuts? Is it June or July? That's a preposterous investment process. And I don't mean to be pejorative to the client, obviously. I'm actually just being pejorative to the broader universe of investors that I continue to see on social media or on traditional financial media, that 99% of the damn conversations I keep hearing are about, is it 3 cuts or 2 cuts? Is it June or July? It's the stupidest thing I've seen in my career, or one of the stupidest things I've seen in my career. There's so much more going on from the perspective of managing macro cycle risk. And if you're focused on just what Jay Powell is saying or just what the Fed is doing, again, you're going to be missing a tremendous amount of opportunities to make money and protect gains in financial markets. And so that's why we are out here refreshing each of our quantitative risk management signals and doing the daily deep dive grind work, the grunt work that nobody else wants to do in terms of understanding what's exactly happening in the U.S. and global economies for our clients. And that's why they pay us. And that's why most of our clients have been here since day one. And we appreciate you guys. So we'll wrap it up there. Thanks for joining us. This is Darius Dale presenting our Macro Minute for Thursday, April 4th, 2024. Again, appreciate that. As you guys can tell, I'm obviously very passionate about helping clients make and save money in global financial markets. And so I just want to make sure that investors realize that there is, in fact, a better way than bean counting, whether it's going to be 2 or 3 rate cuts this year, if it's June or July. Trust me, there's a much better way to make and save money in financial markets. So come join us whenever you get a chance. Cheers.